Hey guys, we're here with Kevin Green today. So excited to talk with Kevin. Kevin and I haven't gotten to talk as much as we usually do at the moment, but always excited when I can hit him up on a weekend and be like, Kevin, we're going to put in some overtime this weekend. So excited to have you on today, man. There's so much going on in the market. The market's volatile. Got gold up on Friday, the market down, silver hitting 50, backing off. We've got so much going on in the commodities markets. We got so much going on in oil. Oil's kind of crashing down. More than anything, I was like, I got to bring Kevin on to talk about all this stuff between the S&P 500, oil, the dollar, the Fed, interest rates. This is the guy I want to talk to. So, what are you thinking, Kevin? Like we're looking at these markets. There's so much volatility. Do you think this is the end of it? Do you think it's like a quick sell-off, or do you think it's going to turn into something more?
Yeah, it's a good question. And Jason, I always appreciate you having me on. And yeah, we're going to try to work this out and try to get this going a little bit more when it comes to the frequency. I'm still working in the background in order to do that. Some of the hurdles that I'm facing here. But look, we obviously had that sell off on Friday. Everybody's freaking out. You have that gauge where I don't have a Substack that I write, but I do have a Substack. I read Substacks all the time. And what I always find very funny is like anytime that we have more than a 1% down day, like everybody's like, oh, yeah, this is the top. I knew this is going to happen. Right. Or you see these like emergency bulletins when it comes to Substack. So it's always, crack me up here a bit. But we did get this sell-off on Friday. Obviously, the catalyst is the post from President Trump around 100% tariffs potentially on China, and that's where we started seeing a sell-off. But one thing that we have to be mindful of as traders and investors, in my opinion, markets sometimes find reasons to sell off, and sometimes the catalyst is not the only reason why they sell off. And I think that's exactly what we actually did see. There were actually some warning signs that were on the calendar there, especially within the markets. Now, I've been off all last week. It's always funny. I take a week off. I take a couple of days, and it's like the last day that I have off is usually when the markets provide some volatility. So it's always fun to come back on a Monday morning and really chop this up on the network here. But the market has, I believe, probably did try to find a reason to sell off, maybe take some chips off the table here. And this catalyst, when you're looking at the Trump tariffs potentially increasing when it comes to China, I think is exactly what that was. If you kind of look at the overall structure, in September, we were actually able to have a nice green advance when you're looking at the S&P 500, counter trend to what we see from a seasonality standpoint. Now, usually in October, you do see actually bullish activity the last 2 weeks of October, but bearish activity the first 2 weeks of October. So if you're looking at this pullback, is it aggressive? Yes. Did we have a 2 standard deviation move when you're looking at the S&P 500 composite volume? Pretty much we got there, right? But this is not outside of the norm when it comes to the seasonality, this restructuring event that is kind of taking place. And actually, in fact, we do have October expiration on Friday, the monthly expiration when it comes to options. So this volatility leading up to that event probably will create maybe a little bit more vol. But we did break some technical structures. We have the S&P 500 up here right now on the 1-year daily chart. What did we break? We broke the primary channel line that we've been developing pretty much since, I believe, May, if I'm not mistaken, middle of May. The resistance as well as support has been a really good gauge for us. Good buying opportunities at support, selling opportunities at resistance. We have now broken that channel. Okay, that's number one. If you notice that channel line at the bottom, that white line also coincided with this blue line, the 20-day moving average. Did we break that on Friday? We did. Now, what are we doing? We're pretty much testing the 50-day moving average. Now, this is the S&P 500, the SPX. We did get another, let's say, 0.5%, 0.75% sell-off in the after hours on Friday because of a little bit more clarity as to what could actually potentially happen here when it comes to the tariffs. So if you're looking at the E-mini S&P 500 futures, we are trading at the 50-day moving average. So what do you look at right now for this market, technically speaking? 50-day moving average, what you would like to see from a technical standpoint, we go down, test it, come back, try to retest the 20-day moving average. Then it's anybody's guess. That 20-day moving average, once again, coincides with that lower trend line. Does an area of support now turn into resistance? From a technical standpoint, you got to think about that. If we do get a flush down, you're looking at that 200-day moving average. It's not going to be the first one. The 200-day moving average is sitting at 60.50. But I've been talking about this on the network, and those that know, I watch options flows. I look at the structural levels that we have within options. It's been very popular lately. Everybody's talking about it. But 6,200 is actually your key area to support for this market when you're talking about the S&P 500. A pullback to the 6,200 and us moving higher is actually not something that's out of the norm. We break below 6,200, that's where we actually have a major problem. So I would say from a technical standpoint, it looks like the setup is potentially for, you can even call it a dead cat. Let's call it a dead cat. We'll discount the bounce that potentially could happen on Monday or Tuesday. And then we kind of go from there. But I wouldn't freak out quite yet. We did see some consolidation. Obviously, we saw some loss of momentum when you're looking at that MACD. We are seeing a bearish cross. It's still above the zero, but bearish cross, 12 EMA below the 26 EMA. But look how aggressive that RSI also readjusting. That's the one to the down at the bottom there. That's a very aggressive readjustment here. So even if we get another follow through day, let's say it's even 1.5% or so, you could actually say RSI goes from, obviously overbought now to going to oversold. We had a bearish divergence taking place before this. We had all the technical signs that a pullback was on the horizon. We just needed that spark. Now, I want to also kind of highlight here too, and I want to kick it back to you. We have seen this before, and everybody's kind of comparing this to, oh man, what happened in February? This time is different in that scenario. Is 100% tariff on China something that's, let's call it realistic? No, I mean, effectively, that would be an embargo on China. That would cause us, obviously, some issues. It would cause China some issues. We know that. The market knows that. The 10-year Treasury bond knows that. Look at the 10-year Treasury. I think completely screamed to the upside when you're looking at Treasury bond prices, and then you started seeing yields move to the downside. That is signaling to me, potentially, that the bond market's calling BS on this November 1st deadline. The true catalyst of a sell-off, or where the market really does get concerned, is if you see dollar down, yields down, equity down. Remember, back in the first time around earlier this year, what was the true catalyst of that reversal from the White House and from the administration? Dollar moved lower, equities were moving lower, but also yields were moving higher. That means cash is fleeing this market in the US and going elsewhere. And then you start saying to yourself, where does that go? Does it go to emerging markets? Probably not right now. You do have a little bit of a debt crisis situation in Argentina. We'll talk about that. I know we have a lot to talk about, but the Argentina thing, put that in the back of your mind. That's not over yet. So is emerging markets, could that be an area? Maybe, maybe not, because there's some potentially systemic risk that's there in that particular space of the market. Could it be the Eurozone? That could be the case as well, as a small flight to safety. So I say take a stair-step approach. If you're a technical trader, you're looking at the 50-day and saying, okay, looking for a little bit of a bounce here, a potential 50% retracement from high to low from that candle on Friday. And let's see if we actually have some sellers selling into that strength or not. Or do we see a further breakdown? I don't think that announcement alone, Jason, if you're asking me this question, I don't think the announcement alone from Friday is enough for the bears to really take over this market yet. You need a couple of more things to kind of go wrong. We'll talk about that here in a second here, but I take it step by step. We did break some structure. We have to be mindful of that. But a retracement or a retest of that structure is not outside of the norm as well. We have seen that in the past, or even a consolidation before either a further breakdown or a recovery back to the upside.
Yeah, I love that, Kevin, because you covered everything in the space. Because really, when you're looking at the S&P 500, so many people get into this. Okay, it's just the price. It's just this. The only thing you can look at is the S&P 500. But it's really like there's a macro catalyst here, and I think you're right. Where if we see this environment where everything's an exodus out of the United States again, which is kind of what we saw earlier this year, that would be troubling. And that signal that we got earlier this year, I think it was a down month in bond prices, down month in the dollar and the S&P 500. When you had that all together, if you go back in time, you really don't see many quarters, months that are like that in history. So that was something that was kind of new and interesting to kind of look at. But I do think that, you're right, where I don't think this is it. I don't think this is the catalyst we finally need. I think, once again, it's watch the price structure. If we start to go lower here, we make a lower high. I would get a little bit more bearish. Let's say Monday opens, which it's normal for Friday to be down. than a Monday to be down. That's very normal. But if Tuesday happens and there's no reversal or a turnaround Tuesday, as we call it, that would be also something I'd be looking out for here. I do think this is normal volatility season. We do usually see a little bit of volatility at this point. I do think also, I was talking to a buddy about this the other day. I'm also a little bit more bullish on holding my positions if the VIX is a little bit higher. I really didn't like the VIX hanging out so low for so long. Like, you knew something was about to happen. Last time on the show, you were talking about this. There's a possibility of something happening at some point. And I think too many people got complacent. It's when you go on Twitter. This is a thing that's hilarious to me. You go on X or Twitter or whatever you call it these days, and you're sitting there and you go and you're seeing 500 Robinhood accounts. Look how much money I'm making. Oh, just crossed my $1 million mark. Just cost my $5 million mark. Just cost my $20 million mark. Like, you start to see things like that, and they're just guys who are buying call options. You're running into some frothy times. So, to me it was, and watching the people post their losses on Friday was the most wildest thing I've seen on Twitter in a long time, because they're just like, yeah, I'm down 500K. I'm down like, a couple million. I'm down this, there was a bunch of that on Friday. So I think it's shocking to people, but I think people really have to understand the market goes up and it goes down. Like, that's important to understand, because you're not going to just make money in a straight line. It's great. You took advantage of it. That's awesome. But, if you're using call options, you got to have targets when to get out of these things. If you're trend following, you might still be in the trade, but you also have to position size properly. Whatever you do, however you do it, like, there's a way to do it right and there's a way to do it wrong. And it seemed like a lot of people did it wrong, and they got caught on the wrong side of this currently, which I think kind of sparked a lot more of the selling than I think we would have seen in another scenario.
Yeah, I would agree. When we see these sell-offs, it's very easy, especially for influencers, to try to find what is the catalyst or what's that reason why, and what's going to be the thing that breaks. And I don't think it's really, you want to be able to have that stuff on your radar, but like, don't have like this one notion of this is going to be the thing that breaks this market, and then have that drive your decisions, because once the market can stay irrational for a very long time. Now, mind you, I'm not bullish on this market, but I am cognizant of the fact that this market continues to ride up, and you can't really like go counter trend to that for too long. And so what are the things that really created or had people buy back into this market for equity valuations to continue to move higher? I think that's really the bigger question here. Is it policy from the White House? Yes, it is. Is it artificial intelligence and these spending deals and things like that? We can talk about that. I had a post about that. Is that frothy behavior? It is. But is that the sign that things are going to end? No, not yet. Not yet. And then you have this, like, this leveraging of crypto and altcoins and stuff like that. We had a flash crash. There's a lot of interesting activity that happened on Friday when it comes to the alts. I won't dive into that, but there is some things that are kind of like shady at best, and probably really corrupt at worst, though. But when you look at that, even that situation, how much is that a systemic risk for equity valuations? And I'm of the belief that it's not something that's too systemic at this point, right? Now, obviously, we had the FTX situation that also occurred, but you need usually several different catalysts to really knock you down in this market. And is a tariff threat that's going to start on November 1st really going to be that catalyst to really knock you down? I don't think it is. This time is different from April and what we're looking at from February. And here's the reason why. In February, did we have a trade deal with, and I'm going to use trade deal very loosely, guys. Let's call it framework, okay? Because I don't think we've actually had any official trade deals with any of these countries. And I would say maybe the numbers themselves that are being reported, and I'm not even trying to be political here, look at the European dollars of the amount of money Europe intends on spending in the next 4 years, $750 billion on the energy front. We don't have that capacity to meet that in 4 years at all, right? Like, just number wise, we just don't have that capacity. No matter how much dollars you throw, you just don't have enough time to get that type of commitment together. So is that number really real? I would say Oil markets, energy markets have been discounting that announcement ever since that it came out, right? And rightfully so. But you need to have other catalysts in order for us to kind of drop here. And let's go over a couple of them that you could have on the radar and that I'm kind of focusing on here. Okay, you had the trade deal situation. Is that going to be a problem? Potentially. We have seen President Trump kind of reverse that policy fairly quickly. It seems like China wanted him to come to the table, and maybe we do get a deal here. Maybe they got his attention now. That could be one thing that we could be focusing on. Maybe it gets a little bit more serious. But if you're looking at rare earth metals and minerals are not actually rare, right? They're not actually rare. We have a bunch here. The mining is not the issue. The processing or the smelting or the refining of those minerals is the issue, which we don't have that much of an infrastructure. MP Materials has some infrastructure. Albemarle has some infrastructure. There's another smaller company that's now in the headlines here that has a little bit of an operation that they're trying to build up. Looks like the US is going to support that. But we don't have we can mine all that we want, but if we can't process and refine what we're mining, we don't have any power. China is the one that processes this stuff. They can process it. If you look at Australia and their setup, Australia probably has the most rare materials or rare minerals out in the world right now. When you're looking at mining operations, pure mining operations. But what do they have to do? They actually have to export that over to China, and then they bring it back over to the United States because they have infrastructure, and that might be actually a play here if you're looking at Australia, but they just don't have the capacity. It's going to take some time for us to really try to build that out. So I understand the 100% tariffs and going back and forth and tit for tat and trying to have some leverage. But if you actually look at the end game right now, it's still going to put us behind the 8 ball for a lot of things. And it's not just artificial intelligence. We're talking about just even the basic things, the tablets, the iPhones, the this, that, and the other that's going to be impacted, missile defense systems, everything. So I think if you're kind of looking at the longer game, there is going to have to be potentially some form of a resolution. And if not, that's where we actually have that problem. Let's look at some other spaces here. Argentina is another one. Very big risk market that is out there when you're kind of looking at what's happening down in South America. Now, we had Scott Bessent, on Thursday, kind of announced that we're going to be backstopping them, $20 billion worth of pesos. We're doing a swap here, a currency swap. What does that mean? That means the U.S. is buying pesos. We give them dollars. Those dollars are supposed to strengthen their reserves, and hopefully that provides them enough confidence for investors to be able to hold up. But if you look at the Argentinian, one of the Argentina ETFs, I think it's AGTN, I'll find it here in a second. But we had a nice pop the day of the announcement. Next day, faded like 75% of that. So that also says, hey, even the signal of us trying to backstop Argentina really didn't hold that well, at least for now. And then the risk becomes, how much more do we have to put dollars to work in that market in order for them to be sustainable? And does that come with some political angst here in the United States, given the fact that we have a shutdown? So that's another risk. Altogether, you focus on that. We also had the auto market. We have a little bit of a blow up here when it comes to auto financing and auto financing loans. There were some exotics that also are kind of blowing up some people's balance sheets, especially when you're looking at some of the major banks that have exposure. But when you're looking at the total dollar amount of the exposure that they do have risk, it's actually kind of, it's inconsequential in some respects. Yeah, RGT. Inconsequential in some respects to their overall balance sheet there, but there is some risk. So there's definitely risk that is out there. And then you also have the artificial intelligence trade, and that going to be this bust type of scenario. Could that be the case? It could. You are seeing like vendor financing taking place right now, but credit events, and I'll capstone it with this. Credit events usually don't occur, whether it's AI financing and unable to turn enough revenue to cover that financing deal structure, right? Or if it comes to sovereign debt here in the United States, sovereigns in Argentina that could spill over in some respects, auto delinquencies, credit card delinquencies. Usually those debt cycles, those credit cycles usually don't kick off until people need cash, right? That's what kicked off Lehman and Lehman Brothers, Bear Stearns. Yeah, that was the catalyst. They needed money, and then when they needed the money, guess what? Everybody's like, we could price these at this, but we don't have the cash, and that's really what creates a domino effect. I don't think we are there yet, where institutions, especially financial institutions, are starving for cash and trying to liquidate assets in order to fortify their balance sheet. I just don't think that we're there yet. Could this be the first catalyst? It could. But I think that you have to treat this as a little bit of a pullback for now until you actually get other risk items on the horizon here to actually truly flush us and make this a cycle. I might be wrong, but that's how I kind of look at it. What do you think?
No, I agree. It's just when we're looking at these markets, it's very dynamic, and I like what you said earlier with the fact of, don't get stuck on it's got to be one thing. Like Kevin said, like there's like you could make a list of 10 things, that it could possibly be happening, and then the 11th thing could happen and you wouldn't have any idea. So I think it's really interesting, fascinating times, and a lot of things can kind of happen. So let's move on to the next one. Sorry if you guys can hear the dogs. I don't know what's going on upstairs. But
Yeah.
so log chart. Let's talk about this, Kevin.
Yeah, so we have a log chart here. I believe I have it at, you're looking at basically from 2000 up to 2025 here. So, you're looking at these pullbacks. Is this something that we were already hitting a resistance level here? Now, this is a log chart. What does a log chart do? As you have more, as the price continues to expand higher, let's say S&P goes from 2000 to 4,000 or 5,000. If you're just looking at it and you're not really trying to scale that price action, the exaggerated moves to the upside are basically near-term prices, 6,000, 7,000 level, 8,000 level, looks really kind of distort the overall primary trend. So in order to reduce that, you do a log chart. This is basically trying to create a range of prices within a certain data set, and then basically looking at the prices within that range. I'm trying to really do a high level overview of what log charts do, but they're basically trying to remove or reduce as much as they possibly can variability of prices because of nominal the nominal value of something, right? If something moves from $1 to $2, that's 100%, right? But if something moves from $10 to $11, that's 10%. So you don't want to have that distortion. In order for you to reduce that distortion, you can create log charts. There's other ways that you can also do this as well. The reason why I bring this up, we are hitting an area of resistance. Right. So we were actually breaking above that area of resistance. So are we having a look above and then fail moment? That could be also the case. Now, do not look at the MACDs. The MACDs, RSIs, that they don't adjust for the log itself, right? But if you're looking at just the overall trend, this wedge pattern that's been developing for the last 15 years or so, we were hitting the upper end of resistance. Now, from a technical standpoint, what if we were hitting the upper end of resistance, blow through it, and break out? That could be the case. But if you kind of go look at the past, we could actually ride this area of resistance. This doesn't mean that the market has to aggressively re-rate to the downside. You got to be mindful that we're riding an area of resistance when you're looking at the log chart. I also have another chart in here, so I want to go through a couple of these really quickly here, because somebody was bringing up volatility. Volatility that was actually the chart volatility was creeping up. Okay, so back in late September or so, I've actually started bringing this up on the network here. You started seeing high yield credit spreads moving a little bit higher, VIX moving higher as the VIX itself, and then there's VIX spread. I look at the VIX minus 3-month VIX. I also look at VIX minus the front month VIX futures contract. That's actually a little bit of my favorite one because it's a little bit more dynamic. And you're looking basically for either like a compression of that spread, or even a backwardation, basically meaning that front month or near-term volatility is priced higher than farther out volatility. That just means that you have some near-term risk. But high yield credit spreads continue to be a very great leading indicator when it comes to potential volatility spikes in the market. And that's exactly what was happening for the last week and a half, 2 weeks. Let's see if that actually does reset itself, right? And the high yield credit spreads are in the white. You're looking at the VIX spread, VIX minus 3-month VIX, that's in the blue. White is for the most part leading the blue. And that generally does kind of happen over time. And when you see these type of dispersions or this difference between volatility starting to inch higher, equity markets inching higher, S&P 500, let's say, that usually doesn't last for too long. I mean, 20% of the time that happens, 80% of the time it does not. So one thing has to break. Either vol breaks lower, or you have equity markets consolidating, or they break lower. It looks like equity markets right now are trying to have a little bit of a volatility reset. Now, when you get to these levels, what we have seen in the past for vol is that it does actually re-rate lower. Sometimes it does not. But most of the time, the next day to 2 days, vol moves lower, which is once again, counter trend bounce could be in the cards here. If you're kind of going back in the past, counter trend bounce in the equity markets could be in the cards. Does that mean all-time highs? I don't know. But we're kind of talking about the next day, 2 days, 3 days. That's what we're focusing on. If you're a swing trader right now and you look at that market move on Friday, that's yellow light at best, caution. But if you're an intraday trader, you see a VIX spike into 2020, and you start seeing things starting to rotate here a little bit, some markets starting to break down, then you're like, oh, okay. People call it both sides of the trade starts to open up, right? The opportunities open up on an intraday basis. But I always go back and say high yield credit spreads, compare that to equity volatility. When you start seeing high yield credit spreads starting to move up out of nowhere, right? Out of nowhere, and equity vol starts to move up a little bit, but equity prices themselves are starting to move up. That's when you got to have your spots on. And actually, once again, that purple, when I actually brought this up at the end of September, the purple is really what we were kind of highlighting. It's very easy indicator to watch. I think a lot of people try to make this stuff really complicated. You got to just kind of keep it simple. Look at the price action, look at the vol structure, and you kind of go from there. I want to capstone this side of it. You can't move too much to the upside without vol re-rating higher. If you're an institutional trader, I'm not talking about the retail trader. I'm not even talking about the guy that's got 50 million, $100 million. I'm talking about people that are managing hundreds of billion dollars in portfolio cash, right? The pension funds that are out there, the JPMs and things of that nature. Once you have equity valuations or equity prices moving so far away and volatility becomes so cheap, they have risk models in place that say, hey, we gotta buy vol. Like at some point we have to put vol on. So you're going to hear a lot this week about systematic vol, traders and things of that nature. There's a point to that. At some point we get too far out stretch. We just have to re-rate volatility. But that doesn't mean that it has to happen and we have this down 6 month or 8 month period in the market. In fact, our pullbacks have been more aggressive back to the upside than ever here. And I would say that since that's been the trend in the past, I would kind of expect that here in the future. And until something breaks. And then I did say I was going to be the last thing. The only other big risk, we already talked about some of the other credit things and all that other stuff. But if and when the government does reopen, the flood of the economic data that does come out, which was kind of a lot of it was trending bearish for the economy and inflation was remaining sticky. That also may be your day where like volatility hits, right? Like, oh man, we didn't know jobs were decelerating in that fashion. We didn't know that inflation crept to the upside as aggressively. I mean, the Cleveland Fed's looking at 0.4% month over month, right? That's going to be reported. Seems like the government's going to report the 24th. When it comes to inflation, because they have to do these cost of living adjustments and things of that nature. But I think that day to day where everything drops might create a little bit more volatility that we have to be mindful of. And so we'll keep an eye out on that. But it's not surprising we saw the pullback. You just needed the spark. I think people just wanted to de-risk. We'll re-risk to a point. And we'll probably find some opportunities here. And 70%, 75% of portfolio managers right now are underperforming the S&P 500 or underperforming their index. They got to put money to work here. So I think they're going to try to find a little bit of a bottom, maybe a little bit of a pullback. And then that's probably where you're going to see a lot of this aggressiveness, this chase into high beta once again to capstone this year, which would align pretty much with that November, December holiday swing here. So cautiously optimistic. I want to see, I'd like to see us kind of pull back even more. Honestly, I'd like to see us move back to the 200 day and kind of have a reset. I'm not sure if we're going to be doing that though. Long rant, my bad.
No, you're good.
What are your thoughts?
That's what we're here for, Kevin. Everybody hears me all week long, man. We're here to talk to you. But yeah, no, I think if you look at the S&P 500 correlated to the VIX, if you look at HYG correlated to the VIX, like however you do it, there's so many ways to understand it, and everybody gets so confused when that happens, where they go, "Oh my God, the S&P 500, the VIX are moving up at the same time." It's like, yes, that's usually a bad sign. Especially when the VIX is really low. If the VIX is below 15, 14, and you're starting to see that correlation rise together, That's something that doesn't always happen and usually leads to big pullbacks, sell-offs. Every single sell-off, basically, you can point to it, and that has happened before every single one of them. So something to watch out for. Kevin broke it down really well. So let's talk about, actually, let's go back to talk about oil. I'm sure everybody wants to hear from you about oil today. I do. I want to hear what you're thinking here. We're seeing these breakdowns. We're seeing a lot of pain here in the oil markets. Most frustrating trade out there. I keep telling everybody to be patient here. It's not something that I want to front run, especially commodities. When you see commodities really break out, and they're making a move, that's when you want to be into them. When they're range bound, they can just be range bound for a really long time and just frustrate the hell out of you. So basically here, everybody's arguing about a range at the moment. We're all stuck in a range. Nothing has really completely happened, but I want to hear your opinion. What are you thinking here? We are kind of breaking down some support. We're seeing some sell-offs, some more selling pressure. What's going on fundamentally? What's going on technically? And what are you seeing here in the oil market?
Yeah, look, oil, in my opinion, is still a really decent gauge as to the macroeconomic environment. So that's my thing. So obviously, it is showing a signal. It's showing a signal that we have economic slowing here. Now, there's other factors in place, because as soon as I say that, everybody's gonna be like, dude, well, this, that, and the other. We'll talk about some of those, right? But at the end of the day, brass tacks, you are seeing a fundamental breakdown here. Could it go lower? It probably could. Earlier this year, I wrote a Q1, thoughts about what's happening in Q1. I haven't followed up on anything of that. There's some other things and the reasons why I can't write those at this point in time, for those that have been looking at it and DMing me about it. But we can talk about this here. If you're looking at the weakness, or if you're looking at the weekly chart here, this is the daily, but if you're looking at even the weekly chart, you could see a situation where we were losing momentum pretty much throughout the whole year. We had some spikes because of geopolitical risks, and then you started moving that to the downside here. I think this kind of kicked off this time last week. Was it Monday last week? It wasn't Monday last week. 2 weeks ago. 2 weeks ago, we had this Reuters report. OPEC's going to increase their production quotas, and there's a difference between quotas and actual production, but the production quotas by 512,000 barrels per day, which was absolutely ridiculous. Market kind of latched onto that. That kind of was your first signal, your first self flush. You had the announcement of Hamas, Israel coming up to some form of an agreement. There's seemingly some geopolitical risk premium being taken out of the market because of that. Israel's not an oil producer. If you're looking at that immediate region, there wasn't, outside of Iran, wasn't really that much risk when it comes to oil infrastructure, at least at that point when we started seeing a little bit of de-escalation. You're starting to see people kind of sell that off here. You have production that's actually looking fairly healthy if you, I don't want to say if you trust the numbers, but if you include oil production as well as everything else that's considered to be petroleum related, which is kind of bucketed into this 13.3 million barrels per day or 13.5 or whatever, production has been fairly healthy. You did have some refiners that were kind of going offline because of some issues as well that caught a little bit of a bid for oil. And right now, if you're looking at the EIA, they are stating that gasoline demand is actually increasing and moving higher. I kind of doubt that. I think that you do have some supply issues or supply gluts that are going to be hitting the market here. It seems like OPEC Plus, for the most part, believe that demand's still holding up over the long term, and they want to bring their production quotas up. I think they're also still trying to realign production, especially when you're looking at Iraq and Kazakhstan. There's some countries that definitely were overproducing, maybe even underreporting that overproduction as well. So you're having a little bit of a re-rating there, and I think you're starting to see Saudi Arabia really trying to take some of that capacity that they have and put that online as well. I think Russia, if you're kind of looking at their standpoint, they don't really want to increase production too much because of two things. One, their refining operations, as well as their just oil operations just in general, is obviously seeing some headwinds when it comes to the Russia-Ukraine conflict itself, deeper strikes into Russia, but also the increase in supply in the market pushes prices lower, and then that obviously impacts their revenue to be able to fund this war. So you may have a little bit of a battle between Saudi Arabia and Russia taking place right now. And once again, I think you also have, I think the bigger factor is the slowing that the market's really pricing in when you're looking at the oil patch here. You can see that within gasoline as well. Not a recommendation, but it's fallen out of favor at this point. Let's say that it gets to 57.5 or even 55. Do we have a touch of 55 buyer step in? Do you have a 55 touch and then a gap lower? Just talking about $40 to $45. That could be possible as well. That has to also then coincide with GDP contracting and a whole list of issues here. I think you're getting closer to a support zone to see a technical bounce to the upside. But I do believe that this is also kind of pricing in some macroeconomic weakness from China, which has more than enough inventory right now. When you're kind of looking at their stockpiles, they've been one of the bigger drivers here, but they're not really consuming the stuff. They're just basically storing it up, and they might be storing it for geopolitical issues or potential geopolitical risk items as well that we have to be mindful of. So technically speaking, getting to a zone of support, I don't think the fundamental or the supply landscape right now is really conducive for a very strong move in crude. The demand side seems a little bit lackluster, to say the least. But you love commodities when they completely become oversold or they could become overbought. And so this is a level where you could see traders stepping in on a longer term basis, not saying, oh, next week is going to bounce or the week after it's going to bounce. But if you look at maybe a longer out trade, say the June of next year trade, and you start trying to prepare for that, you could look at a particular bounce that does happen here. But I think the demand side, in my opinion, doesn't look that great. Supply side doesn't really look that great here. And what this will eventually do is take rigs offline. Production will go lower. Domestic producers will readjust to this. You're already seeing the layoff announcements even before this stuff happens. So if you look at the bullish landscape of this, say by June or July of next year, this is actually a pretty decent setup, just looking at the fundamentals and the technicals right now to try to take a shot long, but you got to be able to withstand maybe some of the headwinds that we might have over the next couple of months or so. That's how I kind of look at crude oil. Production will eventually right size to where prices are at right now. You're not going to see them, well, let's produce more and drive prices lower. It's just not how that happens here. So doesn't look great, but I think you get more towards a value area for potential longer term long here.
Nice. No, I mean, this is what everybody's like continuing. I get a bunch of questions about oil lately, and I was like, this morning, Kevin will be the perfect person to ask what's going on with oil, what's going on with energy. Great explanation there. Let's hop to copper. Copper's up here. It peaked above $5 for a minute, and then it sold back off. Now we're just chopping around once again. So what are we looking at here? It looks like there's possibly a new buy signal coming in if it does hold up. For me, I really want to see it get back above over 5 and really sustain up there.
Yeah. Well, so you started seeing copper was consolidating. We talked, 3 weeks ago? Maybe a month ago?
Month ago now, yeah.
So every once in a while, I like to go and reference what we talked about in the past. And sometimes we have commentary where you are very spot on. Sometimes I have commentary where it's like, hey, so this actually does happen. I think that we had a 50 split from the last time that we talked here, Jason, because you were very bullish on the copper front. That was before we actually had Freeport-McMoRan have their earnings, which is, once again, I go back and say, that's why you hate the miners sometimes.
Oh, yeah.
Individually, they sometimes can mess up. Unfortunately, this situation that they had for Freeport-McMoRan was out of their control for the most part. So let's give a backdrop for those individuals that are watching and understand what's actually happening in copper, because this is not the same that's happening in silver. It's not the same that's what's happening in palladium or platinum. Copper's got its own thing. Now, this is a weekly chart here. You can see that MACD really wants to curl into a bullish formation, 12 EMA above the 26. And this is also on a weekly chart here. You are hitting close to a particular neckline. But copper obviously has been, because of the tariffs, we started seeing a bid being pushed into copper. We started seeing these kind of topping formations. We had this big push to the upside, and then we had this massive 27% drop in one day. I think it was the biggest day in copper for it to drop. Why is that? Because we have tariffs, but the tariffs did not include the refined copper, which is what we actually care about. So copper pulled back, it consolidated, it looked like it wanted to break down, but what also then happened? In Indonesia, there's this copper mine. And it's not only copper, right? They're producing gold out of this thing, silver out of this thing as well. But this copper mine basically got flooded because of some torrential rains in Indonesia, and it collapsed. Like I think it's like 2 or 3 of the major arms within this copper mine, and I believe, you'll quote me on this, but there's a couple of people that actually lost their lives, unfortunately, because of this event and because of this washout. It's unsafe to be at that copper mine, and now they're not able to produce. Now, Freeport-McMoRan announced that they did have a force majeure. Basically, what that means is that you have a contract. Jason, I got to deliver 100 pounds of copper to you, and I have copper. I have a mine. I can mine this whole thing. But let's say something wild happens, right? My warehouse. This is gonna sound stupid. My warehouse burnt down, and the heat was so hot that it melted the copper, and then the copper went into the waterway system or whatever, right? The copper is gone. I can't deliver it to you. Then you go out and say, hey, force majeure, meaning I can't deliver to you the contract that we kind of stated here. I take the hit. I also have to then kind of help you out, try to find where that supply can come from, or we can make a new contract, or you have other companies that are going to take the helm here. So we started seeing that. Indonesia is going to be offline. Freeport is saying end of the first half of 2026, potentially that mine can be brought offline. I think the market's really kind of pricing in probably start of Q4 2026. So that is going to constrain supply of copper ore, if you will. And so you started seeing copper actually moving a little bit higher here. There's also this redoubling down. You're going to have nuclear. You're going to have this, that, and the other. All of these energy products for AI. You got to update the grid. That means that demand's going to go higher. But actually the last 2 days, it's not only because of the mining story that pushed this higher, but you are seeing internal copper demand rising in China, which is interesting, but be cautious of that. China has a significant amount of smelting capacity. They have overcapacity right now when it comes to smelting, basically meaning they take that copper ore or recycled copper, they melt it down into whatever they need, and they implement it back into the market. They have a significant supply or when it comes to the operations of the of copper smelting. So the demand picture is inching up in some respects for China, but also understand that they probably can meet that demand at some point in time. So I think this is a near-term catalyst. But copper does have some tailwinds right now. I mean, if you take that mine, I think it was like one of the biggest, it's actually, if not the biggest copper mine in the world when it comes to copper ore production, at least for Freeport-McMoRan, that's going to have impact the supply chain here. And so you are seeing some buyers stepping in. We are still holding this higher high, higher low formation, and you're looking at a potential breakout, and you have retail traders that are looking at every single type of metal that is out there and saying, okay, let's squeeze that. Can we squeeze this one? Does this one have an opportunity? So this one looks like it does actually have some tailwinds to it, chart wise, as well as from the fundamental standpoint.
Yeah, I'm going to bring up the copper miners in 1 second. But yeah, so I want to just talk about the copper miners too, because that's what we were really, the only thing that was really giving me conviction was the copper miners. The copper miners were holding up so well while all of this was happening that I just kind of, continued to have that, understand that risk on was kind of coming into that space. And so as we continued to see risk on in that space, I was continuing to be bullish on that space. And that's really all it is. None of us have crystal balls. It's just weighing the probabilities and using our models the best way we can. But the copper miners looked really good. I mean, like insanely good. So these continue to hold up much better than copper at the moment. If we look at copper all over the globe too, if you look at the LME, you look at Chinese copper prices and so on, you're seeing that these are holding up really well too. So I think the copper miners will do well. I think a better way of playing it, just I wanted to highlight this because you mentioned this earlier, the individual names in some of these like micro cap, small cap areas are always going to be really tough to trade. You're going to have earnings, you're going to have event risk, you're going to have all types of stuff that can shock it to, down 20, 30%. But then if you look at, or more, or if you look at the whole, the ETF as a whole, or the XME or something, like it's an easier way to play this for people who aren't very familiar with the space. Another way to play it is if you do own, a bunch of, let's say, US names, Southern Copper is not a US name, but that's another one. But another big name, Southern Copper, BVN, and so on. Like you own all these big names around the world, let's say. That's a better way to do it than just having one name with all the event risk. Because a lot of people just go, okay, Freeport, biggest name. I want to own that one. That one will do great. And it's like there's a bunch of them in there that look really good, look much better even. I mean, Hud Bay, that's another one that looks great. You know, what is it, HBD? God, why can't I remember that right now? BD? Hud Bay. Somebody give me that because I'm an ETF. That's why. That would be why. Okay. I was right. Okay. HBM, you know, that's hitting new highs, continuing to just trend nicely. Like that's another one that we're seeing and just looks really good. Southern Copper, another one looks really good. You know, huge trend here, long term, in an uptrend. So like I would say like stick to either, you know, a couple names, couple big names, however you're gonna do it. But like if you don't know the space well, definitely go with the ETFs. There's so much event risk, what Kevin said. And not to mention copper miners are going to always be volatile. You're never gonna have a beautiful, easy trend trading the copper miners. It's always gonna be messy, it's always gonna be volatile, just like the gold miners are volatile. It's the reason why people are attracted to it, because it does make you a lot of money. So that downside volatility might come into play. That upside volatility can be great as well, but understand it goes both ways, just like the market.
Yeah. Can I comment on this real quick?
Yeah.
You have Southern Copper up. All right. So, and those are trade. You guys know this. What's the theme right now within the hard asset space, right? The rare earth minerals, things of that nature, right? There's also dollars being put. You can even say uranium as well. There's dollars from the U.S. government that's being put for domestic production. So the Freeport-McMoRan news hit. I'm not sure if we can do a comp. I know I'm putting you on the spot here. The Freeport-McMoRan news hit. That's Indonesia. There's only 3 copper miners here in the United States that actually do have scalable copper mining production. All right. And here's the 3 names: Freeport-McMoRan, Southern Copper, Rio Tinto. Those are the 3. So if you're looking at this, not a recommendation at all. But if you think about it and you say, hey, is the Trump administration now going to look at copper and say, hey, this is a national security risk and we need to put money to work in order to make sure that we solidify our supplies? Do we have copper mining operations? We do. What's the other problem that we have with copper? And this is exactly, if you go to the beginning of this video, I ranted about this. I'm not going to rant on it too much here. We have copper supplies. We can mine copper all day, but we can't refine the darn thing as to scale like we want to. China has the smelting operations. We call it, smelting at that point, right? China has the smelting operations. And I want to bring this up and really kind of drive this home, because people are looking at like, we need to mine. No, we need to smelt. We need to refine. Who's going to be the beneficiaries of the refining space? Are we going to put dollars to work? Because that's where the real dollars are going to be coming in at. That you can mine all you want, but if you can't refine your products, you can't refine your ore to scale, you got a problem. Who's got that refining aspect here in the United States? Southern Copper, Freeport-McMoRan, Rio Tinto. Rio consolidating, started to move higher. If you coincide that with FCX has moved down, there's a reason why. There was an inverse relationship. Southern Copper, another one. Freeport-McMoRan moved to the downside. Southern Copper called it a nice bid. Now, I do not like the daily chart right now. Looks like a little bit of a blow-off top candle when it comes to Southern Copper. But once again, there's only 3. Yeah, if you look at the daily chart on the candle structure portion, you could actually make the case that it's an evening star candle pattern. So, we'll be mindful of that. But could they be targets? Could these 3 names be targets for U.S. funding? It's possible. I'm not saying it's gonna happen, but you got to start looking at a lot of these material names and these metal names and saying, okay, not only the fundamental, is there going to be demand for copper, this, that, and the other, cool. What's really driving the prices of a lot of these companies now? It's the U.S. investment. And that's, I think you saw that rotation. Now, some of that probably is already has been priced in here. But I'm just giving you the landscape. If you want to know the names that can smelt here in the United States that have the robust operations, there's only 3. And one of them, unfortunately, their largest mine within their portfolio from a copper standpoint is going to be down for 7 months, 8 months. So there might be something there. There might be something there. Never a guarantee, but there might be something there. And it just, you also look at like some of the battery names and all this other stuff. But I think it's really important for us to kind of highlight. There's only 3 names. There's other mining companies, but they all have exposure to South America, this, that, and the other. If you're looking at just domestic production itself, 3 names: Southern Copper, Freeport, Rio Tinto.
Nice. Yeah, I mean, it's an interesting time to be a commodities trader because a lot of these are moving and a lot of people are finally getting interested in this space, but understand like it's a very cyclical space. It moves during certain times and those moves are usually very volatile, and make sure you know what you're trading inside of that sector. And if you don't, and you're really using the price action and so on, go to the ETFs. It's going to be a much easier way to trade these things and really hang on to the trends if you're trying to do that. So next up we have gold. So, I'm sure everybody wants to talk about gold. Gold's been, the one that's just kind of continued to lead the way. Even on Friday, the market's kind of getting hit. Everything's going, sideways and down and lower. You got uranium basically was up. I think biotechs were up. A couple things were up, but gold just kind of shrugged it all off and continued to just move higher. Had a rough day on Thursday, I think. Silver hit $50. It backed off a bit. Silver spot price hung up. Silver futures went down. Something else, I'm sure you have an opinion on, Kevin. So what are we thinking about gold here? The trend is obviously up, but very crazy at the moment. It's been up in a way that I don't think I've ever seen an asset like gold go up.
Yeah, it makes you a little bit like it doesn't feel great trying to initiate a new long here. Let's say that because you do see kind of this. I mean, what is it, like the last 7 weeks it's been up with like zero, even more than that. 1, 2, 3, 4, 5, 6, 7, 8 weeks, right? 8 weeks continues to trend higher. This is the FOMO portion. Now, I said that 8 months ago. And it's still going up. It seems like this is the FOMO portion, dude. I mean, like, I get it. You are seeing, I mean, don't fight the trend. The trend is still to the upside. You come back, you retest some of these key areas, 20-week moving average, or even I think the 20-week moving average has been a key area of support for gold. Does it come back, retest, you still see it move higher? That could be the case. I think this is, once again, kind of that FOMO feeling. If you look at the ETFs, the ETF flows the 11th week in a row where the positive ETF flows into the GLD or to the gold ETFs. And I'm talking about gold, spot gold futures ETFs. I'm not talking about the GDXs of the world or anything of that nature, right? Just gold itself. So you're seeing the positive ETF flows there. Is it a flight to safety? Is it telling us something? This is another one, and we talked about this earlier. Sometimes at this point in the gold run, is gold telling us something? It is, but no one knows what the hell it's telling us because there's 8,000 different things that it's telling us right now. Is it government spending going higher? Yeah, we already know that. Is it the potential for maybe some sovereign credit to actually break down? Yeah, it's probably that too. Is it central bank buying? Of course it is. Is it India buying? I mean, if you look at India's consumption, India is one of the bigger consumers, like retail consumers, people like yourself and myself, they're one of the bigger ones, right? Are they buying? Yes, they are. All of those factors are just driving into the space here, and it continues to run higher. So you got to trade this. You trade the trend that you have. Is it telling us something? It is, and I don't know. I think it's a bunch of different factors. Honestly, the 4,000 level is going to be key. 4,400. If you look longer term at the pullbacks of gold. Once it has these cycles, it's never actually at a whole like 4,000 or 3,000 or 2,000. It's actually whatever 400 is usually the key. Like 3,400. Go back and look. 3,400. What was that? The consolidation zone. You can see it on the chart there. If you kind of look back at the back in October of 2024, got to around 2,400 or so, consolidated, then broke out to the upside here. You can also say the same thing that kind of occurred in the past as well. This one's an interesting one. I think that there could be. I will say this. Gold is trading risk on with equities, except for Friday. You did see a buck in that trend. I think that's short-lived. When people need cash and people need to raise raise capital, gold is going to be one of those things that does actually hit, and that does get hit. I don't think that you look at this as that safe haven out of equities trade for too long. And if you look at on the daily chart, what's gold doing compared to equities? It's pretty much been almost 1-for-1. It's probably about a 75 to 80% correlation over the last 2 weeks or 3 weeks or so. I don't think that's healthy, but that's just how the market's trading. So it's trading as a risk on asset. I think if we do get this flush in the market, people need to raise capital. I think they're going to take profits in gold. And silver is hitting another key area of resistance as well. I mean, this is it's a huge run. It's a huge run. We hit that 50 level. I'm looking at COMEX. I'm not going off the LME because LME also is in a short squeeze on physicals right now over the last month or so. So the LME prices, in my opinion, they're gonna definitely disconnect from COMEX. Let's just say that. This is a critical area. I think this is a dangerous area. And when I say this is a dangerous area, it's dangerous for both sides of the market. So let me balance this out here. Do you play the breakout long and do you see this massive stretch higher, 30 points, 40 points higher? Does that happen? This cup and handle this cup formation that's been happening for what, the last 20 years or something crazy like that, 17 years? Do we have that breakout? That could be the case. Do we actually build out the handle of that cup and we come back and start retesting $36 or so? That could also be the case, right? That will probably shake out a lot of these retail longs. You know that. A lot of these retail longs that just started getting into this space probably have never experienced a 7% drawdown in silver in a day or 2 days. That stuff actually does happen at blow-off tops or even at consolidations, beginning of consolidation moments. You know that. Gold does the same thing, but silver is even a higher beta trade than gold. Do we have the breakout? Do you try to short it here because you say, hey, this is an area of resistance? Do you try to short it here and try to play that pullback? I think this is a dangerous area. And I don't know where, I don't. If you think about the fundamental landscape of silver, it should still actually, it does still have the fundamental backdrop. You're going to have cutting rates, you have elevated inflation, you're going to have favorable monetary policy. Most likely at some point, if this government shutdown prolongs for too much longer, I think you probably will have fiscal policy also trying to support, right, this market, which leads to expansion and leads to inflation. That makes prices move higher. You got the grid expansion, you got AI, you have data centers, you have all of these other things. Consumption trends then go to the upside here. You also have, last but not least, the catch-up trade to gold. So could it move higher? It could. We were up here 3 weeks ago, and I remember they're probably watching right now. Somebody was like, I think we were sitting at like 30, 38. And they're like, oh, the silver gets to 50. And it's like, dude, the trajectory, this thing's printing 4.5%, 5% weeks. Is the trajectory there? It's there. So it's just be careful at this level. You don't know if this is going to be a massive breakdown or a breakout. It's just hard to initiate a new position at these levels. And if you do, have a tight stop on it. Make sure you maintain your risk because this thing is going to be very volatile.
Yeah, I agree. It's when you're looking at silver, one risk-adjusted return wise this year. I thought this was interesting, Kevin. Gold is actually the lowest risk-adjusted return this year. And people keep coming to me like, "Oh man, that's because gold's the best asset," and blah blah blah. No, this is unheard of. Yes, gold is a lower volatility commodity than most of the commodities on the market. That's true, but it's not this no trend in gold that I've ever seen is this smooth. This is something that's very rare, and it will probably get more volatile as time moves on. But we also have the situation, we have central banks buying it, Poland's buying like crazy. We have all these big buyers kind of coming in and putting in floors. So it's just kind of a different scenario than we've seen in a while, but that's not going to last forever. Now I like gold, still long gold.
Real quick. I want to just real quick before we go to the gold, because I do want to hear your gold thesis here real quick. Mm-hmm. All right. So this happened back in 2021, right? So about 14 years ago or so. It hit that $48 level if you're looking at silver.
Talking about 2011, you mean?
Yeah. And the next week it dropped 31%. Right. So from a technical standpoint, like I said, it makes it very dangerous because you look at it and say, man, that was a hell of a liquidation back then. Is that going to happen this time around or will we break out? So I want to hear your gold thoughts, but putting that into some context as well. As you said, this is not normal. Mm-hmm. It's not. So you said you were liking gold. Sorry about that, man.
No, you're good, man. That's great context, because it's the, when you go back to, I was getting to silver, and when you go back to that period of time, it's like that makes sense that would have been such a big drawdown. We had that huge run basically starting in 2002, 2003 all the way to 2011 with a massive pullback during the great financial crisis, which also goes to Kevin's point. So if you go back to the great financial crisis and you see gold and you see that massive uptrend that happened in gold, then the great financial crisis happens. Everybody goes into risk off mode. What happens to gold? Well, gold goes down as well. Not nearly as much as stocks, and it bottomed out a lot sooner than stocks did. But at the same time, it's, if people need cash, they're going to sell everything to do it. We even saw an extreme case of that during COVID. A lot of people forget about this part. During COVID, the beginning of that cycle, when we started to crash, we saw money going out of the US dollar. And then we saw money going heavily into US bonds, heavily. We saw this massive spike top in bonds one day, and the next thing you know, bonds were selling off like crazy. Gold was selling off like crazy. Stocks were selling off like crazy. Everything anybody could sell was selling off like crazy. And the only thing that was moving up at that point was the dollar, because people were just running into dollars at that point. So, understand that like people will sell every single asset in front of them if they need liquidity. We aren't quite at that point yet, but remember, like, that can happen. So don't think too much into it's kind of like the people who talk about Bitcoin. Hey, Bitcoin, I'm going to go into that because it's a safe haven. Hell no. That thing's going to go down more than stocks will the next crash. When people need money, they're going to sell everything to do it. I'm not hating on Bitcoin. I'm long in at the moment. Just saying that's the way it goes. So, just understanding that. But looking at silver, massive cup and handle pattern going all the way back to 1980 was that one peak right after the 70s. Another peak in 2011, Kevin just highlighted, and then another peak today. So a lot of people are looking at this zone and going, okay, maybe it'll break down. One thing we have seen with commodities over the years is that they have a tendency of, when they break out these big bases, they continue for a little while. So that can happen too. But I also agree with Kevin. So I'm still long silver, just to say exactly what my position is. But at the same time, like, I know that this is a rough zone. Like, and I think there's two ways to do it. And I think the smartest way to do it is, if you already have a position, you're someone like me and you're using a trailing stop and you're sized properly, great, let it run. I've been in this trade for, I think it's about a year and a half now. But if you're a person who doesn't have a position, just wait for it to get above that major resistance level at 49.50. Like, if you're really bullish on silver and you don't have a position, you're missing out on a few percent to basically have a safe trade. Much safer trade than like what Kevin's looking at. Like, you could have this thing pull back on you 30%. You could have this thing, like, if you're using a stop, sure, you can get out of it, but also you could get chopped to death before this thing even breaks out. Death by 1,000 cuts is what we talk about in trading, where you just continue to get, and even if you're sized properly, take 1% loss, 1% loss, 1% loss, 1% loss. Before long, you've lost 10% of your portfolio on one trade idea that you could have just waited for the breakout for. So I think that there's a bunch of ways to look at this trade right now, but I think that as long as I see the gold miners holding up, as long as I see silver continue to outperform gold, I'm staying bullish on this. But at the same time, like, I agree with Kevin, it's a good time to be cautious. And also, gold just moving up all the time is just wild to me. Now, I've been a gold bug. I know Kevin's also a gold and silver bug as well. Nothing wrong with having some physical gold and silver. But as a trader, looking at this thing just go parabolic and continue to move, and the miners are up 130% on a year. That's never happened before. I think GDXJ the other day, when I looked at it, was up like 150% on the year. I mean, these are just numbers that I've never seen before and don't expect to probably see again year to date. So it's, as long as these are holding up, I'm still bullish, but I'm also saying it's a bit frothy here.
Yeah. The silver one's gonna be interesting. You don't want to see for silver. Gold can hold up if we have economic slowing data, right? Because that usually then coincides with vol. That also usually then coincides with the dollar moving lower and people going into gold. Silver, on the other hand, is still an industrial metal, and this is the part of the cycle where people forget, right? Silver, more industrial metal than precious metal. You have to be mindful of that. So silver thrives in higher inflationary environments, economic expansion stories, easier monetary policies, improving or expanded fiscal policy. Those are really the key fundamental ingredients. Now, it could continue to trade up, right? If you have this squeeze, you can continue to trade it up. But if you want the fundamental backdrop, you really want everything to kind of hold in this Goldilocks zone when it comes to economic data. Enough weakness to push the Fed, but not enough weakness where the market's really concerned. That's where it can thrive. I do want to make a mention of two more things here real quick. I know we're coming up on time here.
No, go for it.
Because I'm starting to see this a little bit more, and I want to be able to kind of dispel some of the myths here. ETF, people can short ETFs, but ETFs have an infinite amount of share availability in their structure. So right now I'm seeing a lot of like, hey, silver, the cost of borrowing for SLV is moving higher. That is to a point, but to build out an ETF, how an ETF works on the commodity front or even on the equity front, which is why it's different than equities. And I think this is very important. Let's say we have a stock, Apple, XYZ, and I'm just making some numbers up, right? Let's say if they have 100,000 shares that are outstanding that could be traded public float, right? People are buying and selling this 100,000 lot that's available. When you have an ETF, no matter if it's an equity ETF or if you're looking at a commodity ETF, an equity ETF, let's say it's the SPY, and people keep buying into SPY, they do something called creation units, right? So they go out, they get exposure to the equities, they create more shares. And then when people sell off, we have a 2%, 3% sell-off day, people sell off the SPY, they just reduce the amount of creation units. So ETFs theoretically actually have more, they have infinite amount of shares available, theoretically. Now, when you're talking about the ETF for SLV, and this is the reason why I want to kind of myth bust this here a little bit, just because the short interest goes up, doesn't mean that SLV does not actually has more share creations, more share availability in the marketplace, right? But that does mean they still have to cover that position. So can you have a squeeze by leveraging the SLV? You can, but just also be mindful too, the creation of ETF shares for the SLV will also increase as well, which will distort the shorting of the short interest, if you will, when it comes to those ETFs. So that's a little bit different from just say like an equity, like an Apple or an Amazon or an Oklo for that matter, or what have you, where the ETF structures themselves, they can create more shares and they can take shares off. They do that every day. That's a function of their business. It depends on their exposure. SLV right now from an options front, dude, is getting massive amounts of attention on the options front. And I think that's another reason why we are seeing the squeeze a little bit higher as well. So just something to kind of note, the value or the short interest or the amount of money you have to pay to short SLV right now is increasing. But if you're looking at the share float, that's going to change on a day-by-day basis, just the function of the ETF itself. And I always just go back, and this will be the last thing. I go back and look at silver and go to the CME website. And just look at what the open interest is doing and look at the delivery numbers. Is the deliveries for physical contracts or those that hold contracts right now, is deliveries increasing? Is the physical deliveries increasing? If that's the case, that's usually bullish. And if it's starting to see a decrease, that's usually bearish. And so that's another way to kind of get those there. So yeah, silver's gonna be an interesting one.
It's fascinating.
And maybe you play the week. Yeah. It's a fascinating one here. You know, I bought silver at 15.25, my physical silver. I have some at 15.25. And now I'm looking at it, I'm like, I might want to just sell just 1 ounce, like just 1 ounce, just to say that I did it. You know what I'm saying? Like, hey, like I bought this at 15. I could sell it. You probably get spot silver if you're selling it at a store or something right now. Something like that right now. You probably get, let's say spots going for what, $48. You probably get like maybe $40, 42, maybe $40. I would say maybe $40. Yep. Right? They're gonna take their cut there.
It's a tough one.
Of the best physical trades I've ever made in my life.
It's a tough one because it's a, you know, I have some silver that's from like, you know, the 2000s, you know, and like early 2000s, and like I watched it come and go and come and go, and like I also just think like silver is always going to be the more volatile commodity. Like something like gold, like having that for the next 40 years of my life till I die basically is probably fine. Silver is this thing that just is so volatile. It makes you want to just go, damn, I think I should get rid of some of this.
Yeah.
But at the same time, it's just tough. It's tough.
Yeah, you know, silver is actually tougher to refine than gold is.
Really?
Hmm. That's why silver is actually a lot cheaper than gold. Gold's easier to refine, silver is a lot harder. So the input cost for it to actually become pure, because you have silver ore, but also within that silver ore, you have a whole bunch of stuff, right? You have palladium, you have metals that no one uses.
Yep.
You have to have a lot of inputs, right? There's like a whole process for doing it. So its silver supply is definitely a little bit more plentiful, but the real reason why silver trades at a pretty significant discount to gold is because it costs like 4x to actually like refine it into a silver bar. So yeah, that's kind of a fun fact. It's not that gold is actually more rare. It is rare, but it costs a lot more money for silver.
And you can use gold in a lot. Gold kind of spreads out quite a bit more than silver does, and it's kind of interesting. It was somebody who came up with a story like, you know, thousands of years ago, where basically like people like aliens basically came to the Earth to take the gold back to their atmosphere to fix Mars, and it was because gold was like malleable like that. And like, you know, I was gonna write about it one day, and I was like, I'm gonna leave that alone because I have no idea if that, you know, there's probably no truth to the story, but it's just like hilarious to kind of talk about that and like see that over time little things like that kind of do make some form of sense. But
yeah, I mean the capstone on the Great Pyramid was gold.
Yep.
You know, until it got taken.
Yep.
But you know,
and how much gold was used back then is pretty insane. And you know, basically the whole idea of the story was that they came here to make us into workers, and then us being workers, we were just built to mine gold. And to this day, that's kind of why we all kind of work, you know, like it's kind of like this really like wild story. I mean, it's from like, you know, 4,000 5,000 or years ago is when they found it, so like it's a long time ago, and like the books even predate that by another like 20,000 years, so it's like pretty crazy, but that's interesting. Maybe one day I'll write something about it just to like go through it and put it somewhere, but it's just interesting.
Can I throw one more thing out there before we end it? Just real one more thing. Soybeans, keep that one on the radar. We are harvesting right now. Harvest looks decent. We're a little bit ahead of schedule here. You also have a situation where the ending stockpiles are probably going to be higher than what we estimated at the beginning of the year if you're looking at the USDA estimates out there. And then obviously we are not seeing China buy not one thing when it comes to soybeans. Look, China has been laying off on purchasing soybeans for a fairly long time. The trajectory has been to the downside. The first Trump trade war has really shifted a lot of the purchases for China to Argentina and to Brazil. So we have to be mindful of that. What will be interesting with this bailout thing, I'm going to go on a quick tangent now. What's interesting about the bailout thing it's not even a bailout. It's a swap line. Okay, so we buy pesos, we're giving up dollars. What's interesting about that structure, you would think that the U.S. should actually force Argentina to decouple first before we give them 20 billion, because we do obviously have a lot more peso risk. They peg to the dollar, and if they decoupled, we would actually be able to readjust and reset the agricultural front just in general, because pricing, Argentina has better pricing than the United States, even though we have a little bit better quality when it comes to the bean front here. But this is a situation where this is not just new because of this government shutdown or because of the trade war that China doesn't want to buy our beans. This has been happening for a very long time. We've been losing share when it comes to selling beans to China for a fairly long time. Now, this is just looking at nominal dollars of U.S. exports of soybeans to China. But if you look at China's mix of where they're getting their soybeans from, even that peak that we have up there at 2020 or so, if you look at their overall mix themselves, they were still actually importing more on a relative basis from Argentina and from Brazil than they were the United States. So this is something that has been structural in nature for a fairly long time. I still think that the bean trade, if Trump wants to get a win here, especially a political win, I still think he's going to put that at the forefront of these China trade talks, at least trying to get those commitments. Who knows if they're going to bring them through? Soybeans have been sold off fairly aggressively. This is one where you're going into harvest. Harvest has been pretty decent. You do got some issues when it comes to disease in some respects, but we already had healthy ending stocks from last year. We're going to have healthy inventories for this year. We may actually have a little bit of a situation in South America from the La Nina front that we're going to be seeing here, actually starting kind of like right now. All that to be said, soybeans they're getting hit. I don't think that they're down and out yet. If you're looking for a major turnaround story on China purchases, I don't think that's really kind of probably in the cards unless we kind of push Argentina around when they're down. Keep this one on the radar. A lot of bearish things that are already priced in here. Could it go lower? Definitely can go lower here, especially in the harvest season. But the days where we have a little bit of optimism on the bean front, Jason, you see those beans moving 1.2, 1.5% on just a little bit of an optimistic day. And I think that politically, obviously, it's hitting the administration here. Keep your eye out on that. I think if you get a turnaround on these China trade talks, beans could be setting up pretty well for June of next year as well. Because we will see a pullback. We will see a pullback in acreage planted as prices kind of go down. That's exactly what happened with corn, right? And then demand for corn is actually moving higher. So that's all I got.
Yeah, no, I think it's when we look at soybeans, we look at the grains, like that's something that's just been such a tough trade. But at the same time, it's like it is bottoming out. It is starting to show something. I think really the catalyst is going to be if cattle prices ever start to really roll over. Like that's what we really need to see. I think that's going to be one of the biggest catalysts to just, if you're just looking at the charts, you're just looking at price action, that's one thing to continue to look for. But we had really bad drought in the Midwest this year. I mean, like certain got no rain. Like a lot of the farmers I talked to had a really rough year on top of all the stuff that's going on with the tariff situation. So it's interesting.
Yeah. The drought conditions the drought conditions definitely took the turn for the worse over the last 2 weeks or so, but it also did accelerate the harvest. So it kind of actually just pushed the harvest season up about 2 weeks or so. We'll see how much damage you get from Iowa. I think that's actually probably the bigger risk.
That's what I'm watching too.
Southeastern Illinois, Southwest Illinois, and then in some parts of Iowa. But if you're looking at the harvest levels that are projected, they're still supposed to be fairly healthy. I mean, right now the storage. I'll share this on X. I won't send it to you because we don't have enough time. If you're looking at storage levels right now, even pre-harvest or as we are in harvest season, I think this is the highest level that we've seen as far as beans being stored in 10 years. Let me get this chart real quick. I just saw it. It's actually something crazy. We're close to highest ever actually. Off farm, we're at the highest ever. So there's still a glut, but we'll see.
Still a glut. I mean, this is the hardest thing about this trade. Like I've told people this before, is it is set up so well to do something. However, timing it has been the hardest thing to do in the world. For 2 years, it's kind of been this globally, we've kind of seen the grains have a great setup where fundamentally you could point to it as possibly a catalyst at some point, but the catalyst never came. And I think it's really the meat prices being so high usually puts a lot of pressure on it. Not to mention now we're just starting to bottom out, not to mention the geopolitical situation, not to mention what's going on with the farms and the farmers, not to mention the weather. I mean, it's just there's all these things kind of just keeping it down, but it's kind of like a beach ball underwater. At some point it's going to explode higher. So I like the idea. Keep soybeans on your radar. Who knows if we're going to buy it anytime soon, but I'd be ready to take those buy signals when they come in for sure.
Dude, I mean, you're only about 200 points away from key structurals. I mean, you're talking about COVID-19 lows.
Yep.
If I'm not mistaken. Let me check this chart real quick and then we'll wrap this up. yeah, you're 100 points, 150 points away. I mean, once you start talking about the 900 level, and that's 900 cents, right? So you're talking about $9 a bushel, $9 a bushel.
Yeah.
I mean, come on. Now, can it go lower? It could, but it looks like, I don't know. It looks like it's on its last leg and or like consolidating. It does look like it's consolidating. Keep your eye on those WASD reports, man. The last two reactions on beans from WASD report, because they just been like completely. One of them was like shockingly bullish. Another one that we had, I think the most recent one was like initially bearish, but then there were some bright spots about 2026, 2027 production. Because once again, these prices are going lower. These farmers, there's only a couple of ways that they can actually like sustain prices. It's either you plant more and you try to get the cost per acre down to sustain itself, right? But you need some upfront costs to do so, or you take acreage off market and short and cut supply. One of the two here. I like this consolidation though on the weekly. I mean, it looks like we're going back down to around that 98, 980 ish area, 970 ish. But it's been consolidating here since July. I don't know, and I think I'm of the belief that eventually Donald Trump and President Xi will come up to a trade deal, and I think when that does happen, so watch out, because shorts, there's a lot of shorts in soybeans.
Oh yeah,
we had that same type of cycle actually. I think back in what. August of 2020 was the same thing. I think that's when that deal was signed. So
when you look at that and you look at,
2020,
think about the metals. It's another thing to think about is you think about the metals and you think about like something like platinum, same type of mispositioning. You all of a sudden you get these huge moves when everybody's on one side of the boat. Then the next thing, palladium's the newest one. That thing's been everybody's been on one side of the boat on that thing for a long time. Now we're finally getting a flip. We're seeing the commercials start to go short finally. I don't even know if they actually went short yet because the next report didn't come out because of the government shutdown. But we're still looking at these massive short squeezes in these. I think the rest of the commodities complex will look similar at some point. We don't know when that point exactly will be, but I think that's the part of the reason why Kevin's saying like put it on your radar, because that move's going to probably be violent at some point, and people will make a lot of money very quickly. I mean, here's another thing to think about that's always like going to make me laugh probably till the end of time, which is platinum. Everybody was done with that. There's no way for that to go anywhere. Platinum goes from one of the worst trades in the commodity sector in futures all the way to the number one trade of the year. It went from like down, I think it was like 10% on the year, all the way to up, might even be 70% now. I mean, it's just continued to move up like crazy. So, just understand that this is how commodities really move. That's why I always say like these are trading vehicles. These are not things like we can just buy and hold for the next 30 years. They're trading vehicles. They make big moves very quickly. So have that on the lookout. And Kevin, great having you on, man. Let's do this again when you get some time. And I'm sure everybody enjoyed it. A lot of people came today. Thanks, guys, for hanging out with us. And we'll see you guys soon. I'm sure Kevin and I will get on again on one of these weekends.
Appreciate you.
Yeah, freely.